so in about 40 seconds, we will have a possibility for a setup in the pound CAD and in the USD CAD. So the price will close the bar in 10 seconds. And so indeed, now I see, let me mark on my chart here, an entry setup on the pound CAD, and I will simply mark the chart. I don't call the trade, remember, I simply indicate what I see with the max. So here, I see also an entry setup here with the pound Kiwi and another one with the USD CAD. And once we have defined an entry setup, we have to define where the entry must be made and where we place our stop loss. We have a rule for that. So let me just show you how I would consider that with, let's say, the pound CAD here. I would place my stop loss or my entry somewhere here. Once we get a setup, we like to see the price following through before considering an entry. And I will consider a stop loss here in this place, in this area, which would be a stop loss size of around, so here we have 41 pips plus the spread. The spread is between 3.5 and 4 pips, so let's say 4 pips, so 45 pips for the stop loss. And we call our stop loss an emergency stop loss. ESL, I have said how many pips? 45 pips, I think, if I remember correctly. 45 pips. And similarly with the pound Kiwi, my entry would be already be made, in fact, here. And my stop loss would be here in this area around, no, sorry, here with a stop loss size of about 45 pips approximately. Now, when we have with the max to enter a trade, we have a tool. We have a tool called the trade risk, the max trade manager, helping us to make the trade easier. And for example, the stop loss is just an horizontal line, a red line. We can move with the mouse, and we don't need to mark where we make our entry. But when the price reaches our entry point, we have just to push a one-click button, and the trade is open with the appropriate size. And so we are using position housing to open our trade. For example, here the trade would have been opened to here at this level with a stop loss size of about 24, 26 pips, 25, 26 pips here. And so that trade, max trade manager, makes our life easier because with just one click, we open the trade, we close half of the trade, we close the entire trade, and so it's really easier to make it so. Personally, I never open more than 2 trades simultaneously. So here I have just marked a chart. So on the pound CAD, nothing for the moment. One on the pound Kiwi, one on the USD CAD. Okay? I will simply mark the chart to show you the kind of decision we can make with the max. And don't take these trades, okay? Because we have no right to call trades. In fact, here we are just illustrating how our rules can be applied. Yes, Frank, we have the MTM, so the Max Trade Manager, mark the entry, the exit, so the scale-in, the scale-out when we use them with the Max Standard. It marks also the price entry, the stop loss level, the size of the stop loss. So a lot of informations concerning the trade. And when the trade is closed, it gives also some information about the result of the trade. And so when my trades are opened, what I do, because I have, I would consider I have two open trades here. I would not consider, I would neglect here the pound cap because I have already two open trades. Now I'm focusing on these two trades, and my main task will be to reduce the risk I will have on these trades. The Kiwi is still gaining a lot of strength. The CAD also, and so the price is moving almost immediately to the downside. And so what I do usually is I widen my two charts that way in order not to be distracted by the other charts. So one chart this way and the other chart that way. And now, because the trade is open, I will focus on the situations representing a risk for the trade. My aim being to reduce the risk on the trade. Now, something which is also important here is when we have to consider to open a trade, we have to decide how much risk we take on the trade. And we always express the risk in terms of percentage of the trading account. It may be 0.5%, 1%, 2% of the account per trade. And knowing the size of the stop loss and the percentage of the account for the risk with the position sizing concept, we can, of course, calculate the size of the trade.
Eusebio, you opened up 3 orders.
No. I have said that the pound card, because the two other would have been considered as open, that I would have neglected this one, even if the price has reached the,
Sure.
You have to pay attention, Chris, and to stay concentrated.
I'm answering questions, Eusebio. It's 1 o'clock in the morning. Okay, catch you. Thanks.
Peter asked, what are those 7 colored lines on the chart? Which 7 lines, Peter?
I think the signal bars, Eusebio.
Hi, Gregi. You mean this one? What I'm showing with my pointer here, Peter? Oh, you mean these ones, perhaps? Okay. In blue aqua with a channel is our long-term moving average. It's a moving average representing a long-term perspective. Okay, and it helps to define what is a trend and a counter trend. Then we have 3 other moving averages. We have what we call the red balance line, the blue balance line, and the momentum line, which represent another way to perceive the quality of the trend we are trading. And an important behavior we want to see in these EMAs, EMA because they are exponential moving average, is the concept of angle separation and correct order. We explained all that in details in our course, of course. And if we don't get that condition of angle, separation and correct order, we don't have a trade. It's as simple as that. Okay? Or we have specific settings, but they are very close to very standard settings. So our home base channel, so the blue aqua, correspond to a 200 moving average. The red balance line corresponds to a 100. The blue one to a 50, 100, and the more line to a 20 or 21. We have numbers just a little bit different, but they are very close to them. So very, very standard settings. Okay, I have to pay attention here. We have an exit setup bar on this candle. Let me check if, yeah. This candle has a length of 17 pips, so 5 pips. So somewhere in this area, I will consider to close half of my trade if the price hits that level. So a little bit higher, so right here. So I have an exit rule triggering here, telling me that if the price hits that level here, cross that level, I will reduce my risk by closing half of my trade. Okay? I will not use the scaling concept today. The scaling concept is used in the MAC standard. So these represent situations when we can add to a trade. And so when I have some time on my chart, then I make some notations on the chart. This was a REMO, for example. The REMO is the name of the setup we have on the chart for the pound, the USD CAD. For the pound Kiwi, it was safe and perfect mode. Safe and perfect mode, and so I make some notations on my chart in such a way that later, when I will close my trading day, I can post-review my trade to see if all my trades have been made correctly based on our rules. And with the price moving in our favor, what we do also is we adjust our stop loss. The stop loss, I will explain in a moment why we call it an emergency stop loss. Let me adjust it on the chart here, that way. The stop loss are called an emergency stop loss because they are hard stop loss. And they are used to protect the account in the case we are in a trade and we have a technical problem. For example, the connection, internet connection goes down. And so in such a case, we are blind with our trade. And if we are not able to immediately call our broker, then at least we have that stop loss in place, which will protect the account in the case the price moves against the trade very quickly. Since 2008, this has happened to myself two times. So it's not a rare event. It is not frequent, but it is not a rare event. And so we have to pay attention to that worst case scenario. Our aim is to never let the price hit that emergency stop loss. So it is a protection. Now, when we are in a trade, we have rules telling us where to make our exits in order to handle the trade and to either reduce the loss in the case of a losing trade or to improve, to pay attention here, to improve the result in the case of a winning trade. In this situation, I would be ready to click on the button to make a partial exit. We call such a partial exit an MX, momentum exit or minor exit. And so with the MTM, I would be ready to push on the button if I see the price just crossing that level. And I will tell when I will see that. Okay, I have pushed my button, and so I will have a price execution which can be right on my price level, a little below or a little above. It depends on the slippage. But here, just for the purpose of the illustration, I will suppose my exit has been made properly on the level I have indicated. And so we call that exit an MX. And so the MTM will indicate how many pips is made on that MX and how profit in terms of percentage has been made. Here, I can measure the number of pips. It's 10 pips. 10 pips minus the spread, which is 2 pips, so 8 pips profit on that MX. So 8 pips, and I write plus 8. I have to check something I have not checked previously. The profit was a little small, but still acceptable. So we have also rules telling us that when we are in the context of taking a profit, if we have to take that profit or if we can skip taking that profit. And this is part of our trade risk management. So here we have also an exit rule triggering. And I will consider to make an MX here if the price comes back to this level approximately. So I will draw a level that way. How many pips have I said? So 12.2. 12.2 will be around that level here. Okay. We don't need to be correct, absolutely correct on the pipette. So I will draw here a small white angled line. And because the price is nicely moving in favor of the trade, I will further reduce the stop loss on both charts. That way. Not too much. We need to keep enough places for the stop loss. So here it would be a little too large, too small, sorry. Here that way. Okay. Now you can see on this trade on the USD card, the risk on the second unit is, how many pips? Is 10 pips plus the spread, so 12 pips. 12 pips. So the entire risk for the trade is only 4 pips. 4 pips with a stop loss size of 25 pips. So we can consider we are break even with that trade, should the trade have been made alive, of course. And on the pound Kiwi, the price has not retraced enough to trigger the exit. Connie, I have taken these two trades. First of all, because we had a news on the US dollar, which has been considered somewhat as a disappointment. Even if the news was a good one, it was not good enough. And so shorting the USD card, the US dollar was making sense. And so on my chart, I had two pairs with the US dollar card and the pound US dollar. The pound US dollar has made nothing. I had no entry setup on the pound US dollar, but I had an entry setup on the US dollar card. And very often when we have the US dollar strengthening or weakening, we have a rather good correlation with the pound. And so a nice setup was found on the pound Kiwi, but also on the pound CAD. And with a pound extremely weak and a Kiwi strengthening, we can see that on the chart with on the screen with many more charts. And so this is why I have taken that second trade on the pound kiwi. There are always a reason to take a trade, and this is the kind of decision process I take. So here the price you can see here the price has reached my exit level. So here I have to consider that an MX has been made. And so I would push on the MX button of my MTM tool to close half of the trade here. And the result on that trade would be, how many pips? We can see that, 44 pips. Let's say 44 pips minus the spread, which is 5 pips approximately, so 39 pips. So 39 pips as a profit on this, plus 39, I think. Let me recheck. Yeah, 44 minus 5, so 39. And to better see what the price is doing, I will move my notations here on the left side of the price. That way. Now you can see that for the second unit here, my stop loss is here. The risk on that second unit is only, let's say, 4 pips plus the spread 9 pips. This kind of trade in live conditions would have been a sure profitable trade. Okay. In this case, the USD CAD, we are not yet sure that it will be a profitable trade because the risk is still around 4 pips for the entire position, but the price is moving nicely. So it appears to me you ignore the stochastic oscillator indicator. It is showing oversold. Yes, TOX, and this shows me that you are paying too much attention to indicators. As I have said, the indicators, of course, they are showing oversold conditions, but is this a reason to close the trade? Look here, the price is going downward. The price is going downward. Now, this is the first point. The second point, indeed, such an indicator, like the stochastic of the RSI, will give us exit signals. Not yet. It is not yet giving an exit signal for us. When it will give an exit signals, I will tell you, okay? And depending on the situations on what the price is doing, we will have either to consider that exit signals or to skip that exit signals, okay? And so an exit signal on an indicator or whatever the exit rules is never an automatic exit. It depends on the situations. If you have followed our presentation last week, remember what I have said is we never use fixed rigid rules. We have rules, but each rule must be applied depending on the context. And if the presentation, if the situation will present for these two examples, I will give some indications, okay? Oh, Joe, it's very easy. When you draw, you have that trend line, draw trend line tool, okay, on MetaTrader. And so when you go into the properties of the line, by default in the parameter panel, you have the ray box, which is checked. And so you have an extended line. And so you have simply to edit the properties of the trend line and uncheck the ray box in the parameter panel, and then you can draw any lines in any direction with any length you want. Okay? You're welcome. So going back to your larger time frame observations, is that made by looking at the dashed lines on the chart? So would you share what they are? No, Ken, the dashed line here are Bollinger Bands. Okay, we have the 2 standard and the 1 standard Bollinger Bands. And so, in fact, when we consider an entry setup, we have to always consider what the momentum is, but also what the volatility is. And so we want to have enough momentum and we want to have enough volatility on the technical point of view. Okay? And so this is why we have these indicators. The moving averages will give us the momentum perception, and the Bollinger Bands for some of our entry setup will give us the volatility, enough volatility. We have rules to define where the entries must be made. Okay? We don't have target, Peter. We never consider a price target. Because personally for me, setting a price target is a nonsense. It's a way to force the market. And so why should I fix, for example, a 2-to-1 or a 3-to-1 reward to risk ratio if I can take a 5-to-1? And why should be stubborn to keep a 3-to-1 when the market wants only to give me a 1-to-1? So with the max, we take what the market wants to give us. Okay? If it is only a half hour, we take half hour. If it is 10 hour, we take the 10 hour. So we never fix a target profit. This is why we need to have a very strict risk trade management, in fact, in order to have our around on average 75% winning rate. Let's pay attention to what the price is doing here. I can further adjust my stop loss on this pair here, that way. And on this one, I can also adjust the stop loss this way. And now you can see that on the pound Kiwi pair, the second unit is also risk-free. Okay? And on the USD CAD, the risk on the second unit is only, let's say, 7 pips plus the spread, so 9 pips. 9 pips. So the global risk now on this trade example is only 1 pip. Okay? When I see such a risk, I further adjust my stop loss by 1 pip. Okay, so in such a way that I will virtually be break even. Now, when we are in a risk-free situation or in a sure profit trade, in order to make our final exits, we have two alternatives, and it's the choice of the trader to know which way to use. And on the long term, they are equivalent. You can see that on these two trades, so each trade is considered to be made of 2 units. Okay. For example, let's write on the chart here 2 units, the size of which are explained in our course. When I have considered that one MX was made, I have closed 1 unit. So 1 unit is left open. Okay, so let's write here 1 unit. Let's write it also on the USD CAD pair. So here 2 units. And for the MX, 1 unit. So we are left with 1 open unit. Another question is, when will we close that remaining open unit? And so we have the choice. The choice we advise to our students is, make your exit when the next, or close the remaining open unit when the next exit rule will trigger. Sooner or later, an exit rule will trigger. We can see here, for example, that the store RSI is in a oversold situation, and sooner or later it will give us an exit signals, in which case we'll have to see if the exit signal will apply or not. And similarly for the USD CAD. And so the first way to close the remaining open unit is on the next exit rule triggering. The second way is we can also close the remaining open unit when the entire movement will be invalidated. This movement is what we call a momentum, directional movement, so a directional movement. At some point, that directional movement will be invalidated. And so the second choice is to close the trade when the movement is invalidated. And so, of course, in the course, we explain what the movement invalidation is. The purple line here, which is a line which helps us to define that concept of the movement invalidation. In fact, we have an area defined with the help of that purple line, which is called the movement invalidation area. And when the price behaves in a certain way in that area, if we are still in the trade, we have to close the trade. And you can see, for example, in this case, that that purple line is already below our entry price level. This represents a very, very comfortable situation for the trade. In this case, in the USD CAD pairs, it is approaching our entry price level, but still some distance. It is approximately at the level of our stop loss. And so every line we have on our chart has a specific meaning, and it makes sense to define when the trade or when the movement we are trading makes no longer sense to trade. And so indeed, we consider that in order to define what a trade can be, we have first of all to define what are the types of movement we want to trade. And I am always amazed to see some trading systems even not defining the kind of movement the trading system is aimed to trade. And so in the max, we define exactly what are the movement we want to trade. The targets are flexible depending on what you see, but the stop loss is fixed if the trade goes against you. Yeah, no, the stop loss is adjusted regularly based on a rule. We have also one rule with a nuance in order to regularly adjust our stop loss. And so indeed we don't fix a target. We don't fix a target. Let me give you some. So what three EMS parameters are used here? What are the parameters of? I have already explained them. 200, 100, 50, 100, and 21. Sorry, let me repeat. 200, 100, 50, and 21. Okay? Let me write something on the chart here concerning our rates. So we have, on average, a winning rate of 75%. Okay? We have a losing rate of approximately 50%, 15%. Okay? The 10 remaining percents are break-even trades. Now, with the max primer or the max light I'm illustrating today here, when we have a winning trade on average, the profit is between 0.5 and 1.0 R. So this means 0.5 to 1, between 0.5 to 1 and 1 to 1 on average. And when we have a loss on average, it's rare to have a loss larger than minus 0.5 R. Okay? And so when you know these numbers of your trading system, you can calculate the expectancy. In order to have accurate numbers, you need to consider a large samples of trade you have made. And the minimum size of that sample is usually around 200 trades. In order to have an idea that, or in order to be pretty much sure that you cover many of the market conditions. And so what is the expectancy? The expectancy is very easy. The definition is well known. So the expectancy is the winning rate, so 0.75%, 0.75 times the average profit, and let's take a very conservative number, 0.5 R, minus the losing rate, 15%, times the average loss, 0.5 R. And so when we make that calculation, it's easy to see that the expectancy is positive. I don't have my pocket calculator, but it is easy to make. 0.75 minus 0.15 is 0.6, and times half, it's 0.3. So we have an expectancy of, a minimum expectancy here of 0.3 R, positive. Okay? And this is important to note that the expectancy is positive. If the expectancy is negative, your trading system is a losing one. Now, if it is positive, then you have a good trading system. Now, this is with the max primer or with the max light. With the max standard, the average profit is way larger. It's around 3 hours on average, between 3 and 5 hours. And so the expectancy is way larger. With the max advanced, it's between, on average, 5 and 10 hours, and sometimes larger. And with the max ETF, there is no limit, in fact. It can be a small result, but it can be a very huge, huge result. When I say there is no limit, this is not true. My maximum reward to risk ratio I have ever made was around 60 to 1, so 60 hours. And it was a trade with a 2% risk, so 120% profit. So on USD CAD, stop loss 25 and his target 8 pips. Yeah, but don't compare these numbers. If you don't have the detailed explanation of the way to calculate the stop loss and the way to define how we take a profit, so if you compare the size of the target profit, 8 pips in this case, with a stop loss size of 25 pips, it means nothing. Okay? It means nothing. We will see at the end of the trade what will be the reward to risk ratio. Okay? And keep in mind these numbers. And you know, you don't need to make a large result every day to grow an account. What is important is to be consistent. Consistent, and consistency is achieved when you apply your rules without never, ever deviating from them. And so when you have an opportunity to open the trade, if everything is green, if all the lights are green, as my good friend Craig says, you have to take the trade. Never try to overguess the result of the trade. And when you have to close the trade partially or totally, close the trade. When you have to adjust your stop loss, adjust your stop loss. And so the main focus we have with the max on our trades is never on the result, but it's on the risk. Now I can see, for example, that the price, this candle will close in around 1 minute. I can further adjust my stop loss. And we have a rule telling us where to adjust the stop loss. In this case, also, I can adjust further a little bit my stop loss. and we have a rule telling us where to close it, where to adjust the stop loss. And now the risk on the second unit here is 3 pips plus the flat, 5 pips. And so this trade, should the price hit the stop loss and the trade is closed on that stop loss, it's a no-losing trade. Okay? Now it seems that an exit rule will appear here with the store RSI, but we have to wait for the candle to close in a few seconds. It seems that we will have an exit rule triggering. Yes, we have. So this is an exit setup triggering. We illustrate that by a magenta line. And I will place my exit price somewhere here. And similarly here on the it is this candle which is the setup bar, the exit setup bar. And in this case, I will make my exit. So here we have the exit. So I will push on the button, and here my exit will be, see, without the MTM, it's take a little more time. So it will be at here. And so in both cases, we have the exit. Okay, so here, I would have pushed on my button with the MTM. And here, we may have a small slippage. Okay, based on my experience, 2 out of 3 slippages are in my favor, and 1 out of 3 slippage is against me. But on average, the slippages I have no impact on my result. They compensate each other. And so let me delete these lines. And so when we have closed the trade, we call that exit an XXX, XXX1, here, XXX1 here. So we closed 1 unit, the 1 unit which was remaining as an open unit. Remember, the alternative choice would have been to wait for the movement to be invalidated. Okay. We can also note on the USD CAD that we have a divergence for, I think I have seen one of our max graduate mentioning that we had a divergence, and we have what we call a complex divergence. We call it an external divergence, by the way, which is a strong kind of divergence. So, and when the trade is closed, we can now see how many pips we have made on the second unit. So here 16 minus 2, 14 pips, so plus 14. Plus 14. And on this one, let's say 62 minus 5, 62 minus 5, 57. Plus 57. Okay? Okay, Gregory, have a nice afternoon. Nice to have seen you, Stan. Okay, and so now we have the result. Of course, the MTM, our MTM tool would calculate automatically our result, but let's make it manually. And so in this case, we would have made, and this is the way I note my chart, trade 1 plus we have 39 and 57. This means 96 pips, if I'm counting correctly, 96 pips. The stop loss, I like to remind the stop loss is 45 pips. This means a reward to risk ratio. If someone wants to make the calculation, so we take 96, we divide by 2, this gives 48, and then we divide 48 by 45, So this gives plus 1 point. If someone wants to make the calculation, it would be great. Otherwise, I will be forced to take my desktop calculator. .07, 1.06. Okay, let's calculate it also. Divided by 45. So 1.07. Yeah, indeed. 1.07 R. And you see, it is, in fact, a reward to risk ratio, which is inside approximately the number I have announced previously. And in this case, in the case of the USD CAD, so trade 1 plus, so we have 8 and 14, this means 22, plus 22 pips. The stop loss was, in this case, 25 pips. It is easy to calculate the reward to risk ratio, plus 0.44R. Okay? And again, you can see that the result is almost online with this number I have given here. Remember, these numbers are just averages. Okay? And so with these two trades, which have lasted just a little less than 1 hour, we have made, of course, we can count the pips, 118 pips, but the number of pips is worthless. They mean nothing, especially when the trade size are different. What is much more interesting to consider is what is the reward to risk ratio we have taken if we have taken the same risk on each trade, for example, 1% on each trade. So here it would have been plus 107%. In the second case, plus 0.44%. So the total reward to risk ratio of these two trades would have given 1.5 R. So 1.5% with a 1% risk. Okay, with a 2% risk, this would have given 3% profit. And by the way, with the max standard, here in this case, we would see a scaling, most probably it depends how the candles will close in both cases, but probably a scaling opportunity. Okay? Richard asked, nice to see you, Richard. Did you mention the Wall Street Open? Do you consider this reopen trade? Yeah, the Wall Street Open, which happened 2 minutes ago, creates sometimes some pullbacks. Okay? This is what we call one of our critical time period. And very, very often we see a pullback, not necessarily a reversal, but a pullback in the trend which are unfolding. And so very often they will give an exit, okay, a partial exit. And if the trade is closed, we can possibly, after that, with the max primer or the max lag, consider a re-entry trade or a remo trade. Re-entry and remo are two names for our entry setups when we are already in a well-established trend. The conditions for these two entry setups are different. Of course, they are not exactly the same type of situations, but indeed, if a re-entry or if a remo present themselves, we can consider reopening a new trade. We are flat, and so we can do anything else. On these pairs or on other pairs, we are not tied to the pairs we have just traded. We can still watch what is happening in the other pairs. Let me show what the other pairs are doing. And so we are seeing that we are let me retile the window that way. We are waiting for a setup in the euro yen. We are waiting for a setup in the pound US dollar. We are waiting for a nice, possibly nice setup in the pound yen. Too early, we need to wait for a pullback. We may have an entry setup on the pound Aussie. We are waiting for a setup on the pound CAD, but the pound CAD does not present nicely for the moment. we have to wait. We can wait for a setup, most probably a re-entry setup in the pound kiwi, and most probably a re-entry setup on the USD CAD. It depends of the type of pullback the price will do. And indeed, we can consider any other entry opportunities. We still have, on a practical point of view, when we trade a small time frame, around 1 hour, 1 hour and a half before considering that the day, at least for the European session, is coming to an end. I have also a rule when to stop opening a trade. And so when I'm approaching the Frankfurt close, then I no longer open a new trade or a new scaling when I am using the scaling process of the max standard or the max advance or the max ETF. Okay. And so we may have possibly a re-entry setup here with the pound kiwi. And so, but now at this time, because we are progressively approaching to the end of this session, I will not consider it. We may have an entry setup on the pound CAD, but it does not present nicely. No, it does not present nicely. The conditions are not good. So on the USD CAD, the setup is still to appear. And in the pound kiwi, we are seeing the setup arriving. So it depends how the candle will close. But I will simply mention it. I will not illustrate my trading process here because we are approaching the end of the session. So otherwise, do you have any questions on what you have seen today?
Hey, Eusebio.
Yes, Chris, please.
Just before I disappear, Craig has placed, if anybody wants to learn more about what Eusebio is doing, Craig has placed some extra discount links in the chat section. So
okay, fine.
They'll only be up while this course is on. So if you want to take advantage of it, click on the links and check them out. Well worth it. Thank you.
And when we see here, I see 3 pound pairs. The pound is really weak today. Yeah, but talks on a higher time frame, you apply exactly the same rules, so the same approach. Okay. Personally, I take also trades on the daily time frame. So the rules are exactly the same. The way to analyze a chart is exactly the same. The only difference we have is about the news release. Many of the news release can be ignored in a higher time frame, like the 4-hour or the daily time frame or higher time frame. Otherwise, all the other concepts and all the other rules are exactly the same. Okay? This candle will close in 2 minutes. Let's see if we will get some other setup. Let me retile that window. So the price is moving too fast on the pound yen, so we don't have a good condition to open the trade. We don't have a good condition on the euro US dollar to go long. And sometimes we miss a good movement. And the max traders know why this would not be a good entry situation once we will get an entry setup. And so we do not jump on a pair because the price is just moving. We want to have enough momentum, but not too much. We want to have enough volatility, but not too much. And we want to have a good price entry. And provided all the other aspects, the risk aspect and the global context is still positive. And this example here on the pound CAD and the pound USD CAD and the pound Aussie show that it is important to have the discipline, and normally I always keep on my chart patience and discipline, because we do not want to jump on anything. We may see, and I was telling that a setup to reopen a re-entry trade may possibly appear, but as long as the setup is not confirmed, then we simply wait. This red setup bar on the pound Kiwi is an entry setup bar to go short, but it is not enough to have a short trade. We have to fix where to make the entry and wait for the price to go to that level. On the pound Aussie, we still have to wait. On the pound CAD, we still have to wait. And on all the other pairs, we have nothing interesting. And when we have a price entry level, we still have a rule. We still have a rule telling us if the entry is a good entry or not. Okay? The USD CAD. We have to wait for the price to resume the downtrend. There is a possibility for the USD CAD to go long, but with the max light or the max primer or the max standard, we have to wait for the price to reverse the trend and to go essentially above the home base channel here. Now with the max ETF, we have the possibility to trade a counter trend movement. And so it may happen that this movement will be a deep pullback. We don't know in advance, of course, this may happen. But when that price reverses that down movement into at least a pullback, we have with the max ETF sometimes the possibility to trade that movement as a long trade. Okay? How long do I wait? No, I wait until I have, there is no limit. If the price does not make what I want to see, based on the definition of our entry setups and our entry, we simply ignore the entry. We can see here that on the pound Kiwi, if this candle now, which is a blue candle, ends as a blue candle, this will invalidate the potential re-entry setup we had on the previous red candle. And so we will have to wait for another opportunity. What means the magenta arrow on the pound USD? Okay, we have a small up or down magenta arrows on our chart. They are what we call comfort indicators. They are not signals, okay? They are not signals. They simply represent when our more line crosses the home base channel. So with a down arrow, this represents the more line crossing downward the home base channel, and when we have an up arrow, this represents the more line crossing upward the home base channel. Now, if you observe carefully the chart, if I draw, for example, a vertical line on the present candle, and let's draw it in, let's say, in aqua, it will be seen better. You can see that our moving averages are shifted. Okay, and so the shift corresponds to 3 bars, and so this is why, and the shift of our momentum indicator and home base indicator are the same. So when you see an arrow, you have to check 3 bars later to see if indeed the more line have crossed or not the home base. Okay, but at the close of this candle, blue candle, indeed the more line is crossing upward the home base. So it's simply an indication that the more line has crossed the home base in one direction or the other, which will be one of the conditions of our entry setups. But it's not enough as a condition. And now we are seeing again possibly an opportunity here on the pound Kiwi to the downside. So this red candle was the setup bar. I will draw the vertical line, but I will not dissect it today. And the entry would have been made somewhere in this area. Okay, the stop loss would have been a large stop loss somewhere here, or perhaps even here. So a large stop loss, I don't like when we have a too large, but the stop loss is way too large. So when the stop loss is way too large based on our rule, the reward to risk ratio we can obtain is not worthwhile. And so I don't take the trade. We have limits, maximum limits for our stop loss size. And so typically on the 5-minute time frame, our stop loss will be between 30 and 50 pips. Sometimes a little smaller. We have seen an example with 25 pips. Sometimes a little larger, 75 pips. But I don't consider to open the trade if the stop loss is way larger than 75 pips. Otherwise, the trade can be a winning trade, but the reward to risk ratio is not worthwhile. And so I don't like to make an effort and being paid with a small price, a small amount. I like to be well paid for my effort. You have so many pairs on 5-minute chart to choose. It seems like they are all good to take, difficult to choose. Peter, this is a good question indeed. 8 pairs, when you have some practice, is not too difficult to handle. Okay. You have lost the sound, says Idem. Do you still hear me? Do you still hear me in the room? Okay. Well, so it seems that it's on Idem's side that there is a problem of the sound. So what was I explaining? Yes, with some practice, monitoring 4 to 8 pairs is not difficult. Okay. The problem is don't try to trade any movement you are seeing. Just limit to 1, 2, or 3 trades simultaneously. Now the problem is how will you choose your pairs? And we have indeed a process also we teach in our courses or in our mini courses called the daily professional routine, where I explain what are the tasks I'm doing before I consider to trade in order to define what are the pairs I want to monitor. Because with that preparation routine I have, the aim is to have an idea, just an idea, where the activity can be. Because it's clear that all the pairs will not necessarily move nicely. You can see the euro-yen for the moment is doing, so here it's doing nothing. So when the pair is moving that way, we call that type of behavior choppy mode. We don't trade this type of choppy mode. And the euro-yen, by the way, was not a pair I would have monitored to trade. But I still like to have a look on such a pair because for another reason. When I have an entry set up on the euro-US dollar, very often, not always, very often I have the same setup on the euro-yen, but then I prefer to trade the euro-yen. The euro-yen is more volatile than the euro-US dollar. And when there is more volatility, there is often more profit to make. So there is a process based essentially on the news release, but also something else in order to have a short list of pairs to monitor. And so the pair can be reduced to just 4 pairs, or maybe perhaps 10 pairs. Okay? And if you have too many pairs to monitor, for example, if you consider that 10 pairs are too many pairs to follow, then you can reduce that number of pairs by checking our top 14 pairs. Remember what I have shown previously on our website. Let me show it again. So here we have, after the news release of the week, we have the top 14 pairs, and which have been the best moving pairs during the last 4 weeks. And so if you have, let's say, 10 pairs to monitor through the the choice process, you can reduce these pairs by choosing also the pairs which are here. So to take the common pairs in the two lists. For example, if in your list you have, for example, let's say the Euro card, and you can see the Euro card is not in this top 14 pair, except at the very end of the list, you can drop that pair from the list you are monitoring. And so you can reduce your pairs to monitor to a very small number of pairs. You can see on the pound kiwi, I have said I would not take that example because of the too large stop loss. The price is not moving very much, only 14 pips for the moment. And if you have a too large stop loss, the reward to risk ratio is really not worthwhile. I want to be paid in my trade for my efforts. Okay? And of course, sometimes I will miss a good movement. This happens. But I have never, ever a problem when I miss a nice movement. I prefer to miss a nice movement than to be engaged in a bad trade, in a trade I should have avoided. Okay? Any other questions? Yeah, indeed, the Mo line and the home base are shifted 3 bars. The blue balance line is shifted 5 bars, and the red balance line is shifted 8 bars. You know, there is a lot of discussions about the indicators. And many traders who like to trade price action only, and so price patterns, for example, or support and resistance level, etc., without indicators, use the argument that any indicator, technical indicator, is lagging. And because it is lagging, it is not useful. And there are others who will tell you price action is not enough. You need to use also other tools, and it's always an endless discussion, and for me a worthless discussion. The problem, the fact that an indicator is lagging is not a reason not to use it. Okay, and you can be surprised that so despite the fact that they are lagging, our moving averages, we still add an additional lag, and in the course we explain why. They provide us with a good advantage. And so we use the leg of our moving averages at our advantage. Just one of these advantages. Remember during the presentation last week, I have explained that we identify before any trade consideration the price modes. And we have several price modes. We have the trend mode, we have the counter trend mode, we have the consolidation zone mode, for which we have to make a distinction between a tight one and a large one. We have the choppy mode and we have the spaghetti mode. And for one of these modes, or two of these modes, the fact that we add a lag to our moving averages is greatly helpful to avoid opening a trade in one of these modes where we are sure the trade will be a bad one. And so we use the lagging feature of our indicator at our advantage. And this makes a big, big difference. It's not enough to say an indicator is lagging and so it's worthwhile. No. What is important is what is the relationship between the price behavior and the behavior of any indicator you want to exploit. And is this relationship make sense relatively to the way the price is moving? And if you succeed to have such an approach, such an explanation for each of the indicator you may consider to use, then you can use any indicator at your profit. The add-ons or the scalings, no, they are not automatic with the money manager, Valdemar. So we make only scalings when the conditions are appropriate. A scaling entry is also an entry setup. And so as an entry setup, it has to match some conditions. And so we have technical conditions and we have also risk conditions. We can see immediately when a scaling opportunity happens if that scaling is safe or if it is risky. And if it is risky, we have to skip it. If it is not risky and all the conditions are fulfilled, we can take the scalings, but they are not automatic. Okay? Never. And sometimes, in some circumstances, we may have a scaling which can be taken, which is not technically risky, but it's better to avoid because of the timing aspect. Not all the times are made equal during the day. There are times during the day when it's more risky to add to a trade, to add to a position. So this is what we call in our courses the critical time period. And so we have several of them, and so we describe them in great detail, and this very, very often helps to avoid situations when a scaling, just one scaling, can transform a potential winning trade into a losing one. And believe me, when a scaling taken without attention and transform your trade into a losing one instead of a winning one, this is frustrating. And so we have ways to avoid not all the situations, but many, many of the situations when that scaling is risky. In the past, I can give you some ideas. In the past, based on around 3,000 trades, with a trade containing several scalings, so 1, 2, 3 or more scalings, in 30% of the case, so in 30% of the trade with scalings, my last scaling was a losing scaling. This does not mean that the trade is a losing trade, but the last scaling is a losing scaling, and so reduces the result of the trade. And since I'm much more careful with my scalings relatively to what I have just called the critical time period, I have greatly reduced that number, that percentage of losing scaling. Way less than 30% of the case. Okay, any other questions? No, Ken, the magenta, the purple line here is a line which is used in order to define when the movement is invalidated. It is used to define when the movement is invalidated, but at the same time, it is used in the trade risk management, and it's an important guideline to tell us when a trade becomes safe or not. Okay, but this is explained in detail in our course. Do you use the strength meter in your trading? Yes, Tox, not in the max primer or the max standard, but I teach how to use the currency meter in the max advanced course. And myself, I'm using one, a currency meter, and I have even one under my eyes on another PC, so I cannot show you my currency meter. I use the currency meter called AccuStrength, which is a nice one, a good one. It is a professional one, and again, pay attention, it is not a holy grail. It simply tells me if at some moment a currency is strong, weak, gaining strength, losing strength, gaining weakness, losing weakness, and so on. And the strength of each currency is part of the decision process to define which pair to monitor and when an entry setup is valid or not, when we use it. Okay? But again, it's not a holy grail. You cannot have a miracle from a currency meter, because afterwards, what is a currency meter? It gives simply another view of what the market is doing, but it is exactly the same view. If you observe the 7 pairs with the US dollar, for example, you can define if the US dollar is strong or weak. If you observe the 7 pairs with the euro, you can define visually if the euro is strong or weak. Okay? So virtually, you don't need a currency meter. It makes simply your life a little easier. What RSI parameter is used here? Oh, again, this is not the most important aspect of the question of the trading process here. I can give you the settings, by the way. There is no problem for that. And you can see them on the chart 883. Okay? Let me open. Okay, 883. Simply. But again, with other parameters, the thinking process is exactly the same. It's never an indicator, it's never its setting which is the cornerstone of a trading system. They are simply tools to help you pinpoint special situations. And this does not mean that you have to react to all these special situations. It depends on a set of other factors, as I have explained. We have technical conditions, we have risk conditions, and we have global context conditions. Okay? The global context today were a weak pound, a news release on the US dollar, a strong Aussie, a strong Kiwi, and some other points. Okay? You don't see any links in the chat. Let me see. Perhaps I can reproduce them if I see them.
Hey Eusebio, I've just put them through.
Okay.
Under Bruce's name.
Okay, good.
Okay. Yes, Richard, they're in the go-to chat. Hang on, I'll put them through again. So if anybody's interested in taking up the courses, they start next week. These links are special ones, I think, from what Craig was saying, for this session. So if you're interested in them, then you'll be able to get a slightly better discount off the normal pricing, which is already really good. So thank you.
Ivo, we have 5 levels of the course. I should say 4 levels of the course, in fact. No, 3 levels of the course. Let me explain. The max methodology is a complex methodology. It is based on simple concept, but the rules are not so easy to apply, believe me. And it takes time to master them. And so, in order to give you an idea who we are, what the max may be, we have a very basic introductory level of the max, which is called the max primer. The max primer is a very small subset of the max. Okay? Because the max is a complex methodology, we prefer to teach it in a progressive way. This is why we have the max light, then the max standard. Now, you don't need to take the max light and then the max standard. You can take directly the max standard. Okay? If you take the max standard, in fact, the max light and the max primer are free. And so if you have taken previously the max primer or the max light, you will have a discount of their cost in the cost of the max standard. So virtually, the primer and the light are free. And later on, once you have taken the max standard, any Max Lite courses can be taken for free. Okay? The Max Advanced, we use more advanced concept. More advanced concept. This is why we have to make it a separate course. So we have, and then the Max ETF is another concept, is another level. We add another set of concepts, and so we have in fact 3 levels: standard, advanced, and ETF. And because of their relative complexity, it is important to separate them into different courses. Okay, let's have a last look on the chart. We have an interesting pullback coming in the pound Aussie. We have an interesting situation developing on, so a pullback to develop either if the price resumes the downtrend, a remo or a re-entry. A possibility for a remo, a short remo on the pound card. And you see on the pound Kiwi, it was not worthwhile to take the movement. So it seems that we are progressively approaching to the time when the movement will be exhausted. So, okay, I think it's a good time to wrap up here. Do we have some last questions before we stop here? And I hope you have enjoyed this demonstration. So, oh, thanks, Richard. And so I invite you for next Tuesday. Next Tuesday will be at 3 a.m. Eastern Time. So for the London Open. And so we will see another aspect of the day. And so we'll see what the market will present. And I will dissect the behavior exactly the same way today, but with the London Open. Okay? Okay. Oh, thanks, Dan. Thanks, Joe, Peter, Hector, Ingrid. Welcome, Ingrid. It's always a pleasure. And of course, I thank you very much for those of you who are in our private chat. So it's always a pleasure for me to see you and to illustrate live the thinking process we use with the Max. Well, I thank you very much for your participation, your active participation, your questions, your comments, your remark. And so I always appreciate that. The feedback is always important for us because this helps us to sometimes explain things differently or to be more complete in our explanation. So again, thank you very much. And so I wish you a great weekend and see you next Tuesday for the London Open. And in the meantime, take care. Bye, everyone.